close with a strong rally.
Demand, particularly in Asia and in the second half of Q2. So, what will happen next? Luckily for you and for me, I've got a distinguished panel of experts joining me today to discuss all of these points. To my left, I have Gregory Klumov, who is CEO of Starsys, Hannah Gooch-Peters, who is an equities investment analyst at Sanlam Investments UK, Arnab Das, who's a global investment strategist and Invesco. And finally, last but not least, Fiona Mullen, who is the founder of Sapienta Economics and also local to all of you in Cyprus. Thank you very much for joining me, guys. I really appreciate it. Before I start asking the panel some questions, all of you, whether you're online or here in person, should have had a link to download the Slido app. We will be asking you questions as we go along, and it would be great if you could get involved and answer on the poll so we can see what you think as well. The first question for you today, if you could go into the app, it is basically which asset class do you feel is going to outperform in 2023? You've got you can decide between equities and ETFs, cryptocurrencies, alternatives. Please get involved and answer these questions, and we will share the results on the screen above me. So, welcome, Fiona. I'd like to start with you. Obviously, you are local to Cyprus, and I know you specialize in the kind of macro economic strategy across Cyprus. So could you please, first of all, give me an overview of what has been happening and also how that maybe plays into what's going on in Europe?
Mm-hmm. Yeah, so I wanted to give actually a helicopter view of from a global perspective so that we can talk about assets globally. So what I see, you know, I'm a macro economist. I do focus normally on Cyprus. There's two of my reports you can see in the reading room, the online reading room. But today I want to look at these, what I call three mega trends that I think are going to influence assets going forward for at least the next decade. So I'm not the short-term stock picker person. And those three trends are geopolitics, which is going to mean inflation will continue, green transition, which I think will stay regardless of who wins the election in the US, and artificial intelligence, which we could talk about all day, but I think in terms of assets means a lot more volatility. So why am I saying that? Geopolitics, if you think that 9/11 was the defining moment of how, for the next 2 decades, of how the EU and the US engaged with the world, I think the Ukraine war is the one for the next decade or so. It's really put a priority on, you know, we need to protect ourselves, we're vulnerable, and what do we do? So whereas in the last 2 decades or so, we've been very much focused on efficiency and opening up trade and so on, we've now kind of reversing that, and resilience is more important than efficiency. We need spare capacity. We want to be energy independent. We want to be technology independent if the US is talking about China. there's going to be onshoring, or what do you call it, transshoring, moving from China to other countries. And the outcome of all of that is bound to be higher inflation than we've had in the super low inflation period. You might not reach what we had last year, but you know, if you're producing things in the US or Europe where you might have produced it in China before, you're going to be paying higher wage costs. You're going to have higher wage costs. So that's on the inflation side. And then green transition, there is really going to be very profound change to bank lending and to how markets view the liquidity of bonds and so on. Why? Because the European Central Bank, both from a liquidity side, but also from a regulatory side, is really pushing the green agenda. So the European Central Bank is looking at what bonds am I holding, how green are they? You can see where it's going, that if you've got a green bond, you will get less of a haircut on it than if it's a non-green bond. So that's going to mean it's going to be more expensive. If your green bonds will be less expensive than your non-green bonds, so that will affect sovereign issuance, it will affect corporate issuance. And then on the regulatory side, the banks, right down to, you know, does the guy who delivers your coffee come on an electric bike, or does he come on a moped? And you know which two companies I'm talking about in Cyprus. That is going to, the bank is going to have to start looking at that and make decisions. Can I afford to have that in my portfolio? Because no one will buy my debt if I do. So, and the reason why that will affect the US as well as Europe, there's a really good article actually by ING on this, so I won't go into it. But one of the things it mentions is, if you're even if you're a US company, if you're listing on an European exchange, they're going to be demanding disclosure. And then there's the whole other issue of litigation risk and so on as well. So on the one hand, you might have states in America saying, you know, litigating, passing laws to say you can't do ESG, but I think the bigger risk is you get whacked if you don't do it. So that's the second.
Sorry to interrupt, Fiona, but so how do you think, in terms of obviously investors looking at their portfolios, what would you be looking at specifically then? What, because you mentioned several different aspects then, do you have to consider all of those, or would you say there's one in particular that we should be focusing on?
Well, I think it's in, there's a great deal of, you know, we're in a process where we still haven't solidified what really is an ESG investment or not. So that there's a whole lot much, I'm sure my colleagues here will know better than me, but you know, there's we haven't settled on what the actual formula is yet. You know, there's lots of different ways of, I was at an all-day conference on it a few weeks ago. So, but it's bound to mean that your clients are going to start asking about, you know, what is your ESG content, and it's just going to be the name of the game, even if we don't know what the answer is yet. So it's
sure. Yeah, I mean, and it's probably something that, you know, will be developing for many years to come, I think. Oh, wonderful. So,
and then sorry,
Actually, on your point, I think, you know, if you're an investor and you're perhaps looking to an investment manager to look after your portfolio, you have to decide also what ESG means to you. So it may be that you want to invest in a company that, on a headline level, there are lots of companies out there that screen and give ratings on ESG, and perhaps you want to give one that's already really flying the flag in terms of being very strong in those factors. But also perhaps you may be wanting to look at a company that is perhaps not screening so well, and you want to be really, you know, an activist investor. You want to try and improve how they're operating. So I think there's two different ways of looking at it. And I think that looking at whether a company is just sort of rated good or bad on a high level is not the best way to look at it. I think we can do a lot more as investment professionals and also as investors in deciding what ESG means to us, and then applying that to our portfolios. And then, of course, it also has to be a good investment as well.
Exactly. And I guess it depends at the moment, in terms of everything else that's going on in the kind of global economy, how important it is to you as an investor in your current portfolio. I mean, is everyone going to be investing in ESG?
Well, I think that there are a lot of different trends here, or themes here that Fiona pointed to, and I think ESG absolutely going to be very important. I think it's going to, fit in with these questions of artificial intelligence and the fourth industrial revolution, as well as with the geopolitics. And I was going to focus on the geopolitics a little bit and the
Okay.
geoeconomics,
Yeah.
if I may.
Go
So
for it.
I completely agree with you. I think we're going to be doing a lot of rethinking and reconfiguration of supply chains. And I think what you emphasized, Fiona, was inflation coming from the wage side. I would say, what we're really talking about here is duplicating or triplicating supply chains, right? We're saying, like companies talk about a China plus one kind of strategy. So they have, an operation in China that is going to be destined for serving the massive and, still quite rapidly growing Chinese market. And they're going to have another supply chain somewhere else for the rest of the world. It might be near shored for ESG reasons. It might be friend shored, quote unquote, for geopolitical reasons, right? So we're talking about duplicating or triplicating capital spending, right? And we're talking about doing that for the same size of the global market, right? Because we're putting up trade and investment barriers. And that global market might actually be somewhat smaller than it would otherwise be, because if we're putting a lot more pressure on capital resources and on goods and labor, and contributing to inflation, that probably means lower growth, or at least lower productivity growth than otherwise. Probably means we have higher growth in the short term because we're investing a lot more, so we're going to use a lot more stuff than we used to. But so I think it's a growth pressure and an inflation pressure, or at least productivity growth pressure in the long term, right? And I think, the way we're going to do this, to operationalize this, is through industrial policy. Right, that's what's happening, right? The US has this so-called Inflation Reduction Act. It's got nothing to do with inflation, really. So if anything, like you say, it's an Inflation Expansion Act, right? But they're calling it the Inflation Reduction Act because inflation is such a problem, which I think tells you something, right? We're not going to let inflation get out of control, yet we're going to have to solve all these other problems with all of these interventions in what would otherwise happen in the more or less free market, or the pre-existing rules, at least, that we used to have, right? So I think if you think about it that way, it implies that things are going to be very different from one part of the world to another. And of course, they always are to some degree, because natural resource endowments are different, the geography is different, the climate's different. But now the policies are going to be very different from one place to the next, right? Time was we had one kind of model in the world that we were all aiming towards, right? This kind of Washington consensus, as they used to call it, right? Liberalize, privatize, open up, deregulate, go with Thatcher and Reagan. And now we're reversing that, right? And that reversal is starting actually in the US and in the UK. So it's going to be very different, I think, from place to place. So I think that's a, challenging environment, but the silver lining is that we're going to have lots more opportunities to be selective and active in risk management, and in yield seeking and return enhancement, right, to some degree.
The one consistency that I've heard of recently, I'm sure everyone in the room as well, has been the recent regulation around cryptocurrencies with MiCA. How is that? Obviously, can you give us a perspective from Cyprus, and then we'll go on to Greg to talk about kind of more Europe.
Yeah, we have our own sort of mini Inflation Reduction Act, bunch of policies in Cyprus at the moment, which is interesting, and it's not really about inflation, but yeah. Crypto. So Cyprus had decided that it wanted to be a center for crypto. The CySEC, the regulator here, was saying we want to be a hub for crypto and blockchain and so on. And then all of a sudden, and I'm not quite sure why, they got cold feet and they withdrew this bill on DLT, distributed ledger technology, and saying we better wait for this MiCA regulation instead. So that there's one area of caution already happening, and then my hunch, and this is only a hunch, is that that's probably accelerated in the past couple of weeks because of these sanctions, which I'm sure you've heard about, on individuals in Cyprus. So that has really shaken the whole establishment, and I think what you're going to see is a lot more risk-averse caution about anything that might have a potential whiff of something dodgy about it. And for Cypriots who don't know a lot about cryptocurrencies, that's what they see.
It's perceived.
So the real question, and I think Gregory will answer much better than me, is that the right decision to make? given where we expect crypto to be going in the next few years.
That's interesting. Well, Gregory, you are our crypto expert. So could we talk a bit about this new regulation and how, what impact that's going to have on Europe? Is it a positive?
Well, definitely a positive. Over the course of last 6-7 years, many jurisdictions tried to introduce some crypto regulations, starting from Malta, Kazakhstan, Gibraltar, and others. But then they all stumbled upon banking, because regardless of what laws you've got in your country, you then end up interfering with the local bank, which just doesn't want such risks on the books. And what's good about MiCA is that finally it opens up the market nationwide, Europe. And finally, in Europe, there are opportunities to bank directly with the central bank. There are out of 27 member states, at least one country that supports such setup through a license, MiCA license. And Switzerland is also very open to that. And they also have started issuing licenses that can connect directly to a central bank account. So basically, this is narrow banking reinvented. It always existed, narrow banking concept, but now it's also crypto friendly. And it's available in Europe. And it's the only place in the world, literally, where you can directly access central bank accounts.
That's interesting, because I know that when obviously there's been talk about regulation in cryptocurrency for many years, and some would say people thought that by regulating it, it would make it less popular. But do you see this driving the market?
Yeah, I mean, over the course, again, of last 7-8 years, there were so many contradicting statements from different politicians, lawmakers, monetary ECB officials, right? And partially because most of them didn't understand the technology. Some were lobbying against it because it definitely provides a competition to the traditional banking system in terms of clearing, settling, clearing, custody and settlement services. So there were a lot of contradicting statements, and an average citizen was just completely puzzled. Can he touch it or cannot? Some banks were shutting down accounts completely if you try to send money to crypto exchange or receive. So finally, there is clarity, and now we have to see how big the market will be, because the dollar stablecoin market, for example, is 200 billion, and it's one of the use cases blockchain brought to the world. I mean, go try moving funds, say, from Thailand to Argentina. You can do that over blockchain in a second, and it works.
You become a kind of that global citizen. You can be anywhere in the world and access your funds.
Yeah, especially in this narrative of a digital nomad, where people develop digital skills which they sell online somehow, and they need this efficient and comfortable means of payment to travel around with.
So what would you say?
Does blockchain allow you to make, one of the arguments that I hear is that, Visa and MasterCard, whatever, they transact trillions of transactions a day, which is well beyond the capacity of blockchain, I've heard. I don't know if that, what do you think about that issue, about the technology?
It's controversial again. There are multiple blockchains right now. They all have different security constraints, but on average, you can say safely transact at say $1 to $2 per transaction cost in a dollar equivalent, euro equivalent, globally on demand 24/7.
But the capacity though, how much money can go through?
Billions.
Billions.
So
okay.
Right now it's not trillions, it's billions, but it's sufficient so far. So the market. So this is the only market in crypto that has been growing year over year, the stablecoin market and the transaction and settlement markets in some stable value of unit of account. The Bitcoin, Ethereum, Polygon, Polkadot, and all other 5,000 companies a separate speculation topic, right? But the settlement and the value that was settled over blockchains grew consistently year over year, all these 10 years since the technology came into existence.
And where do you see that going forward? Are we going to see that level of growth again?
Yeah, it accelerates. It will accelerate, and things like MiCA will help.
Okay.
Because again, MiCA now legalizes direct central bank accounts both for institutionals and individuals with crypto friendly settlement. So you don't need commercial bank anymore to transact with crypto.
Sure.
So no commercial bank will have any say on your transactions crypto related.
Yeah.
It's under new regulation. It's the AML is much simpler to do in crypto actually.
Okay.
And there are companies like ours who can do that. And there is it's any amount in crypto to transact right now is 100% legitimate and possible.
Amazing.
Any amount.
And I guess
10 billion, I don't know.
that's amazing. And I guess, for a lot of people say it is the future, and we'll see as we go along. But I know that through difficult times in markets, such as the times that we're going through now with inflation, etc., crypto is often seen as amongst gold as a safe haven asset. And can you tell us a bit more about your experience in terms of how this correlates? And how this works. And also Gregory has put some materials in our reading room. He's got some slides. So if you want to have a look afterwards on our website, there are some materials in the reading room to look at.
Yes, thanks. So it's been almost 20 years since I started allocating capital, first for family office, then in the global micro hedge fund. And when I started trading crypto back in 2013-14, I realized it will be an asset class of liquid alternative subclass, and it inevitably will happen, right? This institutionalization will inevitably happen. And over the course of all these years, we saw crypto correlated to dollar, TIPS, gold, risk assets, S&P, NASDAQ, and others. And even if you take last 2 years, for example, and I have these materials in the reading room, if you want to check, the rolling correlation differs. So that means it's truly an asset class. There are periods when it correlates to gold. There are periods where it anti-correlates to dollar index. There are periods where it correlates to risk assets generally. I mean, we had a conversation with Arnab an hour ago about risk assets and interest rate, right? And treasury market. As we all know, there is a significant yield, short-term yield, which you can accrue now by allocating cash to dollars and euros. And this particular moment, crypto does not correlate to that. What it correlates more of a short term is bank headlines. So Credit Suisse failed, crypto went up. Silicon Valley Bank failed, crypto went up. First Republic, it looks like failing again. Crypto is going up. So it's a trading market, trading environment. Probably too early yet to allocate to a longer duration. So it will remain a trading environment for a couple more months. But on the next 10 years, for sure, crypto will be part of alternative portfolios.
Amazing. So it will, I guess it's part of that diversified portfolio, which does include equities, which brings me nicely to you, Hannah. I know obviously you're our equities specialist here. We do have a question for you regarding equities before we begin. So I'm going to put that live for you. Thank you ever so much for everyone who answered the crypto question. Our question here is that, do you feel that equities are overvalued, undervalued, or maybe you don't have an opinion, but Hannah, how do you feel about equities? I know obviously as a team, you work together to look at the high quality investment equity. Sorry, I can't speak. Can you tell us a bit more about what you do and what you're seeing at the moment?
So it's a really great question, Simona, firstly, because it's not an easy question to answer. Simply, is it, are they undervalued or overvalued? And so I actually looked at the chart this morning that was showing the rolling 3-month outperformance of the stocks in the S&P. And it's at just over 20% of the stocks in the S&P are outperforming on a rolling 3-month basis. And this is the lowest number since 2005. And what does that tell me? That tells me we're in an incredibly concentrated market. And we actually have the largest constituent of the S&P is at its largest weight since the 1980s. And this year, I think we've all been pleasantly surprised by the very strong returns we've had in the global equity market this year. And the reality is around 60% of those returns have been driven by the top few stocks, which are trading on about 3% free cash yield. It's very expensive. And so that does tell me that on a headline level, that equities, particularly in the US, are looking expensive, but that also tells me that there's a real bifurcation in terms of investment returns. And so you've got a large amount of the market underneath is lagging. We've seen some real rotations this year as to what's been leading the way, but that opportunity to add value outside of large cap, sort of particularly technology in the US, is just becoming more and more evident to me. So I would say undervalued.
Okay.
But this is exactly what is pressuring the interest rate, right? So all the multiples compression has been happening, and the growth companies have been catching up with these multiples. Look, Meta, for example, it traded what, 20, 30 EBITDA?
Yeah.
Now it's going down, down, down. This is exactly what interest rates have been influencing.
Yeah, I think there's a narrative in the market that the bond market and the equity market are telling you two different things,
Yeah.
right? But I think actually, if you look under the hood, they're telling you the same thing, which is that the Fed is almost done because of the banking crisis, and the economy is going to slow down possibly quite sharply. So the Fed's going to pivot, interest rates are going to come down. So long duration bonds, long-term bonds, and long-term equities, if you like, tech growth. These are going to outperform things that don't have cash flow yield, like gold, like Bitcoin, like cryptocurrencies, are, you know, a better bet in that kind of environment where interest rates are coming down because the economy is slowing down, the inflation rate's coming down. So I think that's, you know, that's how you can square the circle. It's the same thing going on.
I think actually it's about asking ourselves what's already been discounted as well. So if you actually look at, you're saying about growth doing really, really well this year, that move really started in October last year, and that's where you had to be positioned. And it's often at those points in time where it's most painful. We'd seen by the middle of last year, more than 50% of the companies in the NASDAQ had lost more than half of their value. The scarier thing is close to 20% had lost almost 80% of their value. And it's at that time when you've got to look and you've got to say, actually, we're seeing, if you are a fundamental investor with a valuation framework, you're saying, I'm seeing good upside now in high quality companies. You know, perhaps this rotation between value and growth that had been so violent over the past 3 years, you know, that relationship had really dislocated, value had been outperforming strongly. It was at that time in October last year that you had to be buying into growth. You had to be positioned ready. If you're looking to do that now, just on a, you know, on those more expensive parts of the market, they've already moved. And you're talking about Meta. I mean, that's got to be up 100% year to date,
Yeah.
right? So you know, that feeling has already very much been discounted by large parts
So
of the
you've
market.
missed the boat, basically. If you're looking at growth and, you know, especially in tech stocks, you've missed the boat already.
You have to have a fundamental framework in place. Otherwise, you're simply going to become a momentum investor. And so what you have to do is you have to look at, in my opinion, I don't like splitting companies into buckets of value and growth, because I think that what you have to look is for companies that are able to sustainably, more predictably grow their free cash flows over time, but are at reasonable valuations. And, you know, what's very applicable at the minute is I don't think you should look for companies that are collapsing, like the banks, for example, which, you know, wouldn't fit a typical quality style portfolio because if companies are collapsing, there's usually a fundamental reason behind that collapse.
Yeah.
And so what you're actually looking for is parts of the market that are underappreciated. And a really, really great example actually is European pharmaceuticals. So here's a fact for you today. We're all talking about growth in tech stocks, and the NASDAQ's up 13% in dollars this year. The European Pharmaceuticals Index also up 13% this year. So it's like the ultimate sort of stealth rally. And I think that what's happening is that you know, investors are thinking about this concept that you're talking about, rates coming back, and they're looking for defensives. I think there have been very much a rush into quality. At the start of this year, good, you know, earnings. A lot of the very large cap stocks in the S&P are very profitable, have great balance sheets, fantastic operating margins, and now people are becoming worried about valuations again because of what happened at the end of 2021, when we started to see those most expensive parts of the equity market really pull back substantially. And so you're looking for parts of the market that are underappreciated, but still growing, still quality. And European pharmaceuticals actually fitted that bill. So a company, really boring, slow growth company like Novartis is up 20% in dollars this year. And, you know, it's up 50% from sort of middle of last year. And so at the point in time when, you know, growth is really outperforming, and that's what everyone's talking about, you should be looking ahead of the curve and going into those parts of the market that still fit your bill. You still have your quality and your valuation overlays, but that are just underappreciated at the time.
So do you think we'll move more into that defensive, you know, defensive stocks, and would pharmaceuticals fall into that? Or?
So we're actually reducing ours as we speak now. So if you're looking at companies, just even companies like Unilever, Reckitt Benckiser, Novartis, companies like Pepsi, it's trading on 3% free cash flow yield. It's exceptionally expensive just for a sort of very boring US staples company. And I think that, you know, investors have actually really been hoarding into those. That shift, that moment to try and actually buy into them, is, you know, the easy money has actually been made. And a lot of those companies are up around 10% already this month. So you have to be starting to look ahead again. So what's not been moving, what's underappreciated.
And I know it's maybe a difficult question to answer since we're only in Q2, but what do the panel think about in terms of, will it be growth or value towards the end of this year? Like what if we were to end on one of those, what one would you say we're looking at?
So I think that, I mean, over the past 3 years, we've seen huge rotations. And certainly in the scheme of near-term history, I think the biggest rotations out between value and growth that I've certainly ever seen. And there used to be a very well-established relationship between value and growth in terms of, growth traded at a notable premium to value. And this just completely broke down at the end of 2021. We saw a huge reversal into value. And actually, if you look back, the changing point for that was really Q3 of 2020. And I don't know if any of you remember what happened towards the end of 2020, but we had the vaccine announcement news. And so that's the point in time when the more cyclical parts of the economy, everything that was adjusted to reopening trends, your energy sector, which had been hugely left behind, had a huge move. Your financials started to move, that value rotation just suddenly took hold. And from the middle of May last year, actually, we've had that has completely reversed and growth has been outperforming. So I think it's very difficult just from my standpoint to say that one versus the other will do well this year. I think if you're buying into, say, a growth-based ETF, you have to be very careful of valuations because of the larger constituents of those have become very expensive. But I think the lesson for us would be that you have to have a fundamental framework in place. This is the kind of environment where active management and high conviction in your active management is very, very important, and to adhere to a valuation framework, but to buy companies that are growing and compounding their free cash flows, but at good valuations.
Okay. Anna, do you have any?
Yeah, I think I agree. You have to have a framework, and so I have a macro framework. And what I would say is, I think the real question here is whether the Fed is and maybe other central banks too are really done and they're going to pivot towards easing, or whether there's going to be a plateau in rates, right? I think the market is, if you think before the banking crisis occurred, before SVB started to go down, the short end of the US yield curve had stopped fighting the Fed, right? We're taught not to fight the Fed, but actually what had been happening for a very long time was the market was fighting the Fed, saying the Fed is going to have to give up and start cutting rates very quickly. Before the banking crisis, it finally became convinced by the Fed that inflation was so high, was such a persistent problem, that the Fed was going to keep rates high, keep hiking for a while, and then keep rates high for a while to come after that. And then the banking crisis, I think, convinced everyone, okay, now the Fed has broken something, and we're going to have the financial system crack. Everyone's still traumatized by the global financial crisis and the Eurozone crisis, at least to some degree. And so when the financial system cracks, the labor market's going to crack, the economy is going to go into recession, and rates are going to come right back down. And that'll flip things around between growth and value and everything else on the planet once again. Well, I'm not so sure. It seems to me, these are important financial crises in and of their own right, but they're not, I don't think they're systemic, right? SVB was running a very concentrated, you talked about a narrow bank. Talk about a narrow banking model, right? This one was, borrowing from tech startups, lending to tech startups, and its main hedge against that was long duration treasuries, right? So it had this duration mismatch in everything that it was doing, right? It was borrowing short from the tech sector, lending long to the tech sector or to the US Treasury, which is in effect something of the same risk on the asset side of its balance sheet. That's essentially why it blew up, right? Because once the deposits started coming out, it had nothing short and liquid to sell, right? That hadn't already suffered a big mark-to-market loss that it hadn't realized. So that's SVB. Credit Suisse, we could say, is the opposite, right? A very big systemic bank, and of course, a very important bank. But they had been going through slow motion train wreck, with all due respect, for years. So I think that these things are important, but they're not systemic. There are lots of financial crises that occur almost every time the Fed tightens. That's what happens, right? That's what we mean when we say the Fed tightens, something's going to break, right? That's what we're referring to. Now, this time, it feels to me like the labor market has changed structurally, right? You can hear my American accent. Where I grew up, it's easy to hire and fire. Until now, it's very difficult to hire. So that makes it very difficult to fire. I live in the UK, right? It's easier in the UK, repeatedly to hire and fire than it is in the Eurozone. Not so easy now, right? Labor market's really changed in the Anglo-Saxon economies. In continental Europe, labor market, labor force participation, the number of people actually out there working or looking for a job has been going up. It's gone up to the same trend that it was at before the pandemic. Yet the Eurozone has a record low unemployment rate, right? So the labor market in the Western world has really changed. So I think if there is a recession, it's going to be mild. I think there's even an argument that says we have a kind of softish landing or a bumpy landing, not a hard landing. And if that's the case, rates may not come down at all or very much. And that may make it a lot more complicated. And I think if you buy the kind of long-term story that Fiona and I were talking about, that we're in a more pressured environment for, long-term for investment resources, that implies that real interest rates will remain high. And that maybe, when the Fed does, or other central banks do start cutting, they're not going back down very quickly towards zero, unless there is a systemic financial crisis, not going back down towards zero. And that probably changes this kind of dynamic between growth and value. And I would say, for choice, why not in Q4 of 2023, right? These things could come to a head going into the US election year.
What about the bond market, fixed income? Obviously, that has benefited from what's been going on for quite a while, obviously, while equities were out of favor. Do we see that continuing? Do we see yields increasing?
Yeah, look, I think bonds are back in a way, right? Because, they yield something now, right? I don't know if you remember, right? But several months ago, and certainly several years ago, we had trillions of dollars of bonds with negative yields, right? So $17 trillion of bonds where, as a creditor, you would pay the borrower to, to borrow from you, right? And now that's changed. Now you're getting a significant yield. And I think, again, the story that we're telling of the world having changed from, essentially from zero rates, from low inflation to somewhat higher inflation, somewhat higher pressure, implies that bond yields will remain high. And that, I think, will change the dynamics in almost every market in the world, because, and I don't disagree with anything about all the bottom-up stock picking stuff, but the macro trend in asset markets, I think, is determined by the central bank and indirectly by the central bank's effects on the bond market. So if the relationship between growth and inflation has changed in favor of inflation, it's going to change the relationship of everything in all asset classes in the world, right?
Yeah. Well, Greg, if we come back to crypto, how do you see the current environment and going forward? And obviously, if you look at crypto, how can crypto fit into a portfolio alongside other stocks? Because I mean, you don't have to be just a crypto investor, do you? It can work well alongside equities and bonds.
Yeah, but first thing I want to mention is the growth really collapses in evaluation when Fed starts to cut rates, because this is when the moment of realization of truth is coming in, that things are not good. So when the Fed either plateaus or starts lowering rates, you sell all growth, you sell all risk, you buy long-term bond, because it will mean that we are just halfway through the bear market, which is still a bear market, right? So crypto,
as long as the labor market really cracks.
I mean,
And do we see the labor market situation continuing for quite a while, do you think? Or is this something that we're going to, obviously, that they're trying to change?
Is it difficult to hire people because there's a shortage of labor? Is that the issue? Or it's regulations and this,
Or skills maybe as well?
yeah.
Yeah, look, I think it's a whole bunch of things. One is that a lot of people have made a lifestyle choice and have left, retired early, and they've left the labor market, right? I think that's probably the biggest one in the UK. On top of that, you have long COVID and Brexit, but you don't have those things in the Eurozone. And so there's a shortage of labor. There's strong demand for labor. There's a shortage of labor against that strong demand. There's a supply problem. So I don't think there's been any really meaningful change in the structure and the rules of the labor market. It's just the flows of people in and out of the labor market have changed. And so that implies that, if that prevails, and I think, if we have a systemic crisis, it would be different. But if we don't have a systemic banking crisis, then the labor market, in my opinion, has a good chance of holding up fairly well, which would make for this bumpy landing, and which would make for avoiding the kind of risk of a hard landing, which is why you sell everything and buy bonds or buy long duration in that scenario, right? So that's why I'm suggesting it might be, famous last words, might be somewhat different this time.
But yeah, but could the labor market be misleading? I mean, I've been monitoring, of course, all the macroeconomics for 20 years. And to be honest, I don't really trust some of the numbers, but I trust demographics. So maybe the labor market is not a sign of a strength, but demography, because both developed markets, UK, US, to a lesser extent, and Europe, just have horrible demographics downturn. There's just too many people were retiring and are retiring, and very few
And
are
in the UK,
available
we've had Brexit in the UK. Brexit's been a massive problem, I think,
Yeah.
in terms of obviously a lot of people, like you said, have left the country. So we sometimes don't even have the skill sets available to us.
Yeah, exactly. A friend of mine was renovating an apartment in London, and it's horrible. Like you pay £500 per hour to do some regular job. I mean,
And it's not a good job that you get.
Yeah, yeah. But
Yeah, look, I think demographics is a big part of the story. But there's an element of the demographics that's been kicked into higher gear by the pandemic and by the fact that we protected people through the pandemic. And also because, in many countries, including China, people have had fewer babies in the pandemic. I don't know what people expected, right? You're thrown together with your partner for months on end, you can't go anywhere else. maybe that's, I don't know, who knows, right? But it does look like across many countries, people have had fewer children, right? So not only have people retired early, not only have people left the country, not only did President Trump build this big, beautiful wall that the Mexicans, paid for, fewer people were migrating into the US and the UK. So you had, lots of reasons why the labor market has shifted. But all I'm saying is all those reasons suggest to me that companies which need labor, big and small companies, are going to be they're going to be more likely to hoard labor, right? Which is one of the things that seems to have been going on here. I just say, if you think back over the last several US recoveries, right? Like if you think back, maybe you're not as nerdy as I am, so you don't pay attention to this kind of thing. But if you go back to the 2001 recession after the dot-com bubble burst and after 9/11, right? They said that was a jobless recovery, right? The GDP took off and productivity went up. Companies were quite reluctant to hire people, right? And then after the global financial crisis, 2008, recovery started in 2009, 2010. It was reasonably robust. It was juiced by all the fiscal support, at least initially. They called that one a job loss recovery, right? Growth picked up and it took a long time for companies to want to hire people, right? Once again, right? This time we have a very job full recovery.
Yeah.
It's completely different. So I suspect that, that probably makes the downturn is going to be quite a bit different, and it may not look like a downturn. We already had in the first 2 quarters of last year, we had 2 quarters of negative GDP growth in the US, which most people think of as defining a recession. But it wasn't a recession because the labor market continued to grow very strongly. Last labor market number, everyone's saying, oh, it's way down. It's 200,000 something jobs created. That's actually a pretty big number for the US, given all these demographic changes.
But do you think therefore it's becoming more difficult to predict these things because you're saying it's not really replicating what we've seen before? So
Well, it's important.
sorry.
May I interfere here? It's important because central bank mandate is a mandated institution, right? A central bank in US has a mandate number 1, what? Unemployment, which is different actually in Europe. In Europe, the mandate number 1 is
Inflation.
Price stability. This is the reason in 2008, Trichet was raising rates into a massive recession, right? And hurt the economy.
And again in
completely.
2011.
And again in 2011. So, and these mandates, by the way, they were like since forever. In US, you might have a situation where unemployment will remain low and Fed will just not be there to save all these collapsing growth companies and etc. And employment will be low because of demography, because of some structural changes, etc. So
I think one of my big question with demography, it's interesting. Cyprus is very different. We have. I'm always amazed. I keep thinking, oh no, we're going to have a fall in real estate sales, and then you look at household formation, and it's growing, it's growing, it's growing, it's growing, it's growing. Partly because of immigration, but also, so we will hit it eventually, but we're not quite there with, let's say, older Europe. But my big question on the combination of demography and artificial intelligence. So we're at this stage on the very tail end of the 60s baby boom, where you know, my generation will start retiring and so on. There'll be less labor in the labor market, but maybe that's going to get taken. A lot of that labor will be taken up anyway by robots, let's say, to give it a single name. So you know, maybe things won't be as bad as we think. I mean, it's just a speculative question.
How has the war, though, in Ukraine impacted what's going on here? Because I take it you've also had a lot of people coming to Cyprus from Ukraine. Has that
good, you know,
has that been good for the labour market?
Growth.
Yeah.
A whole bunch of people from both Ukraine and Russia and Belarus are just pouring into.
But you still think
and a lot
that
more welcome than people coming in from other places as well. So,
But you still think that robots, technology are the way forward?
well, no, what I'm saying is, you know, before we knew AI was going to really take off, we were all expecting that not just in the West, but also China and so on, you would have this slowdown in population growth. Population growth drives GDP everywhere. You know, more, it's literally more mouths to feed.
Yeah.
It's very, very close correlation. So, but you have, unless there's a whole bunch of other stuff going on, but let's say ceteris paribus. But what we know, we're going to have a slowing and or falling population, certainly shrinking labor markets. And the assumption is that that's going to be bad for everybody. But what if, because it will create labor shortages, but what if a whole load of those labor shortages are actually just taken up by AI is doing it instead? You know?
Yeah.
So, I mean, there's social instability issues about that, which is another whole other question. Like if you're friend shoring to the Philippines and suddenly all of the jobs, you know, it's a labor exporter, and suddenly there's no jobs anymore and the remittances aren't coming back home, what happens to social stability in those countries and things like that is, you know, that's a whole other question. But,
what does that
my
mean
question for even the panel, you know, showing myself is, do you think it's going to, let's say, temper the downturn that we would expect from demographic changes?
I guess my thought would be that this is you know, what you're describing about the substitution of labor with capital. That's what we're really talking about. That's a long-term trend, and it's going to take, I think, quite a lot of time to get from ChatGPT to you know, fully substituting. So over the course of maybe several economic cycles, you know, those trends will come through and change the cycle. I don't think it's going to do anything for us one way or the other by the end of 23 or during 2024. Although it is fun to talk about, right? That, you know, that I think that, you know, one thing to say is that in this, the challenge with this artificial intelligence and this fourth industrial revolution more generally is that what we're talking about is substituting for higher value parts of the labor market, right? I mean, the first couple of industrial revolutions, they substituted for physical labor, right? And substituted, you know, you substituted mechanized vehicles for horses, or steam power for horse power, or whatever kind of, you know, bullock carts or whatever, right? And of course, that changed the configuration of everything, changed cities, it changed agriculture, it changed the structure of the labor market, and people, you know, the Luddites, right, protested against those sorts of things. What's different about this one is that they're coming for us, right? Or at least some people say that that's, you know, I'm not sure.
We're all going to be out of a job one day. Let's make the most of it.
Just be you and a computer next time.
Exactly. Although technology does fail sometimes, so we need a backup.
But the concept of artificial intelligence, I agree with you, Anna, is not a new one. I mean, we've historically held you know, large weight in our portfolios of software companies, and it's because software companies are looking at repeatable tasks and seeing how they can automate that. And you know, I was reading this morning, artificial intelligence started first really widely being used back apparently in the 1950s, but was first mentioned in the 1300s. I mean, whether or not that's true is another question. But what I want to say is that you know, the market and investors, they like short-term themes, they like stories, and we think we have to really think hard about the limitations of artificial intelligence as well, and it runs off historic data, and it's only as good as the data that it has got banked that it can learn off.
Yeah.
And I think that if you look at a company like, I think Google is probably the best example I can think of. The CFO speaks all the time just about how much data they have and about how much they have used artificial intelligence in their company for such a long time. And you know, there are other ways you can access these themes. You can look at what provides the computing power behind, you know, the artificial intelligence in companies like NVIDIA, but that is so well discounted by the market now. And if you look at it, it's actually trading on 120 times cash flows on generally approved accounting practices. It's phenomenal how much these companies have moved just in such a short amount of time on this news of artificial intelligence. But I do think we have to just be really mindful, actually, that it's not a new concept and also of its limitations.
And maybe it's something that will aid us rather than kind of replace everything that we're doing. I guess it's helping us to make the most of our time, because in the world that we live in, everything is so fast moving that we can be concentrating on things that we can add value to, as opposed to obviously something that the computer can't do.
I think that's the key thing. You always have to adapt, right?
Yeah.
With these changes. And
Yeah.
it's the countries that don't adapt that get left behind. And I think it's very important, you know, in an investment portfolio to think about who's doing the right thing to create the right kind of enabling and social
Maybe
environment.
Cyprus needs to think again about.
Yeah. But that
Something
brings
that
us back
legislation.
onto the first trend that we talked about, which is ESG.
Mhm.
What do you see? Do you think we're going to see more and more inflows into ESG funds or ESG?
Well, I think Hannah
related
made
companies?
this interesting point that I was trying to sort of reinterpret it as you'd have that you said, you know, you don't necessarily treat a company that isn't there yet on ESG as a bad investment, that it's more like an emerging market, you know. I'm trying to think of an equivalent that, you know, you've got a company that's got a long way to go, but that
But they're
implies
making
growth,
they're making the changes.
So I think that's an interesting, you know, way of looking at it. But so it will be the name of the game, but you know, what it actually means for valuations and stuff is something
I think
very
the
different.
best example, actually, to sort of illustrate what Fiona's talking about is defense companies. So people using exclusion-based ESG mandates, defense companies were a very, very typical thing to exclude from your portfolio. But now that we've had the situation in Ukraine, it's actually become a very popular part of inclusion in the ESG portfolio, because it's a good thing to be able to defend your country, to look after your people. And so, I mean, that was also very quickly discounted last year. We had a company like General Dynamics, which makes tanks, nuclear submarines. I mean, that company outperformed the index by about 40% last year. We had companies like, I mean, I don't know if you remember it was in March last year when Germany announced that they were going to increase their defense spending. Companies like Rheinmetall were going up, you know, to multiples. So it's, you know, it's phenomenal. But I think that's a really, really good example of how we have to be open-minded with how we view ESG, and we have to look at it holistically and think about not just now, what is, you know, good practices now, what also can be good for the future. I think it's also very beneficial when you're looking. I think this really speaks to active management and fundamental research, because when you're trying to really understand how a company operates, you spoke about supply chains. If you've got really good control over your supply chains, perhaps you're like a luxury goods company, you're looking about, you know, where do you source your leather from, how do you transport it, who's working on it, who you employed, because you've got ESG goals in mind. Actually, you can drive efficiencies with those companies, you can keep costs down. I think that if you've got a diverse board members, for example, that can speak to being able to better look at your customers and what they might be thinking, what they might want. So I think it's only a good thing. I think we just have to be very open-minded with how we view it, and you know, you have to be very mindful when you're investing in the ESG mandate. What does that mean to you?
Sure. And Greg, I mean, the two things that we haven't really touched on are currencies and commodities. Should we talk about currencies with what's going on with the euro, the dollar? Where do you see that? Where do you see that going? Do you think the dollar's strengthening?
Well, usually, yeah, when US is in trouble and there is a recession, the dollar has always strengthened because people pulled out all their loans and tried to focus on the short-term liquidity. But this time is so interesting because, for example, I just read an article from Stanley Druckenmiller that he's betting against the dollar. basically by totally dismissing this case that in a recession the dollar will go down. Sorry, up. It's also there are some structural mispricing of, say, AAA rated debt versus treasuries, which now yield more than the corporate debt, which is also never happened sort of before. I think current account is one of the major components of currency. If you want to understand how much of that currency can depreciate relative to all others, current account is the best guess. And we saw that again with euro when it was going down all last year. So people were pricing in that current account for Europe will go negative because Germany went negative for a while. But at the end of the day, it kind of recovered. And you see the euro bounce from below parity to 110 is sitting comfortably here. I'm not so much comfortable about commodities because obviously in a recession, all commodities face deflation. And you can already see signs of it. For example, lithium, which was a really hot commodity, is going down, down, down against a rising electric car market, which is booming, continues to boom, but lithium is going down. So oil is a separate animal. It has some embedded put by OPEC, right? Not to.
Do you think that will continue to have an impact, or do you think that's
For sure.
Yeah.
So there is a strategic reserve in US, which has to be replenished at some point. There is OPEC, which is monitoring the situation, and there is Russia, which managed to create cargoes, ships, and move its oil around. And actually, last year, Russia received peak income from oil and oil products, regardless of all the sanctions. So it was like 580 billion something of net imports. Imports, but exports collapsed. Exports and import collapsed because of all the trade restrictions, and ruble was one of the best performing currencies in the end. That again confirms the thesis of a current account. If the nation can generate positive current account, the currency will never go down massively. So
Japan. There are cases where I mean, I agree with you that if you have a perennial current account deficit like the US, that's got to weigh on the currency. But then the current account deficit is being financed somehow. It's being financed by capital inflows. And the balance between the two, if the central bank is not involved in managing the currency, the balance between the two is going to have an effect on the exchange rate, and the interest rate is going to play a role, obviously.
Yeah. Well, Japan broke its bond market. It was buying these bonds at controlling almost half of the equity index, right? The central bank, and almost 70% of the bond market. But yen was really strong for a decade, regardless of. And then finally, a couple of years it broke. So this is potentially what could happen to US dollar. I think Stan is looking at that analog because US will spend what, $1 trillion almost in interest expense this year if interest rate to stay at this level, which is incredible. I mean, they cannot afford such debt, and they also have a lot of unfunded liabilities. So
who am I to disagree with Druckenmiller, right? But I will try. I'll try anyway. So look, China sells $800 billion of goods to the US every year, right? If China and the US are going to decouple, where are those goods going to go? I can tell you, Europe is not going to be able to buy them. The Indians aren't good enough, aren't rich enough, not good enough, or rich enough to, Indian origin, so anyway, aren't rich enough to buy $800 billion from China or anybody else a year. China is intrinsically long dollars. It's a receiver of dollars. And the US needs China for those goods imports. All this talk about decoupling, right? And what have they done? The deficit has gone up. The bilateral deficit between the US and China has gone up. There's a shared interest that both countries have in maintaining that despite all the tensions, or in somehow, keeping that under control. So I think if you look at the current account balances around the world, what you see is some countries are perennially deficit countries, US, UK, India, Brazil, Turkey. Really, it's the US. The only big deficit country in the world is the US. Look at the surplus countries: Saudi Arabia, Russia, China, Japan, Eurozone, most of the time the Eurozone, since the crisis in the Eurozone, right? Perennially surplus countries. The surplus countries and the deficit countries are the same almost throughout eternity, right? For all intents and purposes as an investor. So I wouldn't necessarily use the current account as a reason to buy or sell the currency by itself. I'd have to look at what else suggest to look at what else is going on. So coming to the dollar, I mean, you know, it's true that the Americans have done something that nobody expected with the reserves of the Central Bank of Russia in retaliation for the war. But so did everybody else in the West, right? Eurozone, UK, Canada, Japan, you know, not really in the West, but for these purposes in the West. So the question is, you know, if this is a problem, if it's about the reserves and the freezing of the reserves and maybe the seizure of the reserves, because that's being discussed, to pay for the reconstruction, at least in part, pay for the reconstruction of Ukraine when the time comes, then, you know, there is this view out there that, you know, those damn Yankees, they've gone too far this time, right? And we've got to move away from it. And maybe that'll start to happen. It is starting to happen, it seems, in payments which are being done between Russia and the countries that it has switched its energy exports to away from Europe, China and India in particular, and also, interestingly enough, Saudi Arabia, right? So it appears to be selling energy to China for renminbi, energy to India for rupees, and even to Saudi Arabia, right? Saudi Arabia, which floats on energy, right, is apparently, according to some anecdotes, who knows, is importing energy from oil from Russia in order to sell its own oil abroad at the full price while getting the Russian oil at a discount, right? You could make a profit however you can, right? So maybe all those things will go on.
Yeah.
And maybe they're starting to go on. But my impression is that all of this is still being priced in dollars, and you're still left with the fact that the surplus countries and the deficit countries need each other to be able to buy and sell from. So I think I would be, you know, very cautious on making these predictions about the demise of the dollar.
Yeah, I mean, these predictions will never never materialized, right? There have been claims about the dollar problems for last couple decades at least, and none of them materialized, but it will happen one day. I mean, just on our watch, on our watch. So for sure, and watch how central bank reserves globally start to diversify out of dollar. So gold again started to pick up. China is selling treasuries every single day, right?
So they're just in case they're expecting it.
Yes, and countries like Salvador, for example, even trying to issue Bitcoin bonds. So there is definitely a movement in that direction.
I'd say, you know, one thing, like there's $12 trillion in central bank reserves, right? $12 trillion. And I would ask, you know, China has 3 trillion of those, apparently. Japan has about 2 trillion, and then you have a bunch of countries, you know, 500, 600, 700 billion, right? Where are they going to put $12 trillion worth of reserves if they're not going to put them in the $100 trillion US bond and equity and asset markets? Are they going to put them in euros? You don't have a bond market of any size in Europe other than Italy. You know, I love Italy, but it's not Germany. Right?
Yeah.
You know, the UK, I mean, you know, I love the UK too, but look at what Liz Truss did, right? In 45 days, what she managed to do.
I think that's the interesting, you know, we've, so why is there an incentive to move out of dollars for some countries? Because all of a sudden, you know, the US Treasury might come and get you as it's done with some Cypriots in the last couple of weeks. So, you know, the sanctions can come and get you, they can stop your correspondent banking, they can do it, all kinds of things. But why is the dollar the global reserve currency? It is because of this sort of legal certainty. So that's put a wobble in the legal certainty. But like you said, what's the alternative?
Yeah.
If the alternative is renminbi, you know, you're not going to do that unless you're Chinese or, you know, you've got some sort of geopolitical reason for doing it, let's say. But yeah, fundamentally, even with this, what some people will see as overreach by the US Treasury, it's still the most legally stable currency you've got.
Yeah.
So, you know,
Yeah.
I agree.
Well, sorry to say we're running out of time. So if we can quickly do a speed round, I'll start with you, Fiona. One thing that you think is on your horizon, what are you seeing? What should investors be looking out for over the next, I guess, couple of quarters before the end of this year?
I'm not really a short-term person, but I guess, yeah, it's got to be inflation. Where are we going? And as a result, what's happening with interest rates and so on. Yeah.
Okay, So inflation is going to play a big impact, Anna?
I think it's still, inflation is still
Yeah.
the biggie, I agree.
Yeah.
Short term. Yeah.
Okay, and from your perspective, how I guess how can investors maybe be protecting their portfolio as much as they can against inflation?
Well, look, I guess, you know, the thing to have done when the inflation scare turned out to be a real scare was to have shortened duration, right?
Okay.
Was to have shifted into cash because you got hit very hard in bonds and in equities. So I think that's probably past, and it makes more sense now to have a more balanced portfolio.
Mhm.
I would say, you know, uncertainty is very high in the sense that almost anything could happen, right? I have strong views, and I'm sure many people, many of you, everyone has strong views, but we have to recognize uncertainty is very high, which is a way of saying we don't know what the probabilities of the outcomes are, right? We don't know that it's going to be really a center, a normal bell-shaped curve, and we don't know that the tails of the distribution are going to be very fat. We just don't know. So I think there's a very strong actual intellectual case for being quite well diversified and having a balanced portfolio vis-a-vis bonds and equity, and like we were saying before, vis-a-vis growth and value within equities, right? Not to be betting too heavily on growth really collapsing, and because inflation is coming down quite sharply and that it's all broken, nor to be betting too heavily that, you know, we're going to have a big growth acceleration, right? Because the global economy is really sending a lot of these mixed signals. There seems to be a bit of a reacceleration underway. Yeah.
Hannah, do you agree with that?
I think that my sort of big call for this year would be to be selectively underweight the US market. It's a
Okay.
call we've got going in our portfolios. I talked a lot earlier about how concentrated the market is and how valuations are looking so expensive there. I also think, you know, inflation is obviously a huge problem. And I think if we're thinking about inflation, to invest in high quality companies that can pass like input cost inflation through onto their end consumers that have high barriers to entry, and to just really, really be mindful of valuations.
Okay, brilliant. Greg.
I think crypto will continue to penetrate alternatives portfolios.
Yeah.
And
Okay. How quickly? Before the end
no,
of this year?
it will take time.
Okay.
I mean, but people who are worried about volatility will start from the stablecoin space. It's
Yeah.
something you can hardly lose any money on.
Okay.
And then, but what important is self-custodial or safe custodial. So somewhere safe in a regulated custodian, or self using your own wallets,
Okay.
not in the form of ETF or in the form of tracker or CFD. Not that.
Interesting. And actually, we're going to go over to the audience now for some questions. I have got some questions here, and one of them, Greg, I've got one for Greg quickly, if that's okay. I'm just going to go through it. It was to do with the SVB crisis. Have you seen more money going into crypto since SVB?
For sure, and this is one of the reasons prices increased
Yeah.
of Bitcoin, Ethereum. So people allocated to crypto assets because they didn't feel safe in a crypto, say, enabled institutions. And they converted, say, the crypto dollars in these banks that were crypto friendly in US into Bitcoin and Ethereum. This is why I'm partially skeptical about this rally. And I think Bitcoin can revisit the laws or even trade at 12,000. Don't be afraid of that. It can happen still. But it for sure not will mean that there is some problem with the technology or an asset class.
Sure. And actually, the question I had, do you think that the SVB collapse had anything to do with the fact that they supported crypto-related assets?
Probably the signature is the name that the person is asking about, because Silicon Valley Bank maybe funded some crypto companies, but didn't have a lot of settlement exposure.
Okay.
But Signature Bank and Silvergate Bank on the other side settled a lot of dollar transactions to companies like FTX, which was a fraud. It has nothing to do with the crypto being bad. It's just the human behavior that was inappropriate and without any integrity. So those banks, and Signature particularly, which was a solid bank, was shut down by regulators without any particular cause. There is still a debate or a rumor that it was shut down because of the crypto transactions, but not because of some insolvency or duration mismatch.
Yeah.
Maybe we will know in a couple of years.
Yeah, maybe as it continues to play out. Sorry.
Again, the good news is in Europe already, people can get direct access to central bank accounts with crypto-friendly settlement capacity.
Sure.
So that commercial bank risk is no longer on the table. It will drive the industry forward in a massive way in the next few years.
Thank you, Greg. Sorry, I'll hand over to Adrian. Adrian, you've got the mic, so
Yeah, I was just going to say, anyone in the room who wants to ask a question?
I've got quite a few here, if not. So
They've been
have you guys
submitted.
submitted your questions
You've all
on the
submitted
app?
them on the Slido.
One at the back.
There's one,
Yeah.
Okay.
Okay.
Hi, my name is Achilles Petridis, and my question is the latest print in M2 money supply in US is declining at a faster pace since Great Depression. Any comments or insights in regard to the above?
I don't think we caught that. Can you say
Could
that
you
again?
Start that
Sorry.
again, please.
Okay, my name is Achilles Petridis, and my question is the latest print of M2 money supply in US is declining at the fastest pace since Great Depression. Any comments, insights of the above would be welcome, at least something that ChatGPT cannot answer. Thank you.
Yeah, this is obviously a concerning thing. If you take money supply growth by year, definitely you'll see a frightening thing that this particular year is first time in history it's contracting, but from a very high base. So as economists say, when something rises fast, they say, hey, it's low base. I mean, what do you want? I mean, the headline number growth is big, but low base. So high base, a lot of money were printed and just provided for free to everyone, people just to live on during COVID. So
Yeah.
it's contracting. I mean,
Yeah,
of course, it will be concerning if it continues to contract. If it contracts next year, we'll be in a massive deflationary environment.
Yeah, traditionally, money supply and inflation are pretty linked, and I know that we've had lowest inflation for a long time in the US as well. But it's like Gregory said, it's a baseline effect from the fact that they splurged so much money in the previous period.
Yeah, I'll just say, when the pandemic hit and in 2020 economies were locked down, the US government gave $3 trillion in the first year of the pandemic, $3 trillion of fiscal transfers, which were effectively monetized, right? And that's what caused the first round of the big expansion in money supply in the US. And then that was in the last year of the Trump administration. The first year of the Biden administration, for the vaccines and the reopening, they did another $2 trillion. So over 2 years, $5 trillion, right? So almost 25% of GDP over 2 years, wartime level of spending, except that it was transferred in an untargeted way to everybody. And that's why we had the steepest recession ever in the US, and we had household income go up, and we had household wealth go up, right? And that's why we have a big part, I think, of why we have this inflation pressure, at least the part of it that's coming from the demand side. Now, all these things are, unprecedented, right? So the money growth itself and the money contraction, therefore, from this very high base is unprecedented. And I think this is part of the reason why so many of the great and good have gotten so much wrong this time around, right? Because we've done all these things to the economy that have never been done in modern times, that we have no data for, right? You shut down the services sector. Well, you shut down everything and then reopen goods, shut down the services sector, say to people, you got to stay at home, but here's $5 trillion, do with it what you will. And then we're shocked to see people buying Pelotons.
Which they're now selling post-COVID.
Yeah.
So these traditional
Close
linkage between money supply and inflation has always been quite loose,
Yeah.
right? And that's why most people have stopped being monetarists. But it should be, I agree with what you're implying, right? It should be part of your toolkit. You should think about it. And I agree, it does suggest that the economy is going to slow down, but there's still $1 trillion of excess savings relative to trend in the US. And there's this tightness in the labor market, all of which suggests that spending in the US isn't being financed by consumer credit or mortgage credit, but by income and savings, right? So I'm not sure that that means that the economy is going to collapse or that spending is going to collapse.
I have some slides in the room. I actually disagree because I think the savings rate is almost at the lows in US. And it's incredible to see how
But
fast.
the level of savings is still very high, is what I'm saying. The rate has.
Yeah, but first it went up significantly, but the speed, the acceleration at which it went back to the levels before pandemic. So the speed at which this money was spent is incredible. And now the consumer is levering up. The credit card debt is rising, and the interest on this debt is also rising. What's even worse, that equity analysts are pricing for the consumer staples that the industry will make 220 billion or something, which is a historically unprecedented high number. On average, in America, the consumer staples market is 150 billion. I also have that in the model in the room. Just see how these expectations will fall apart. There is no way, just mathematically impossible, the US consumer will spend the same amount of money this year as they spent in COVID. Yeah, they just have no money to spend. And the whole industry is priced and anticipating that this money is being spent, which is ridiculous mispricing opportunity for me, I think.
Very interesting point to that. Unilever reported their results today, and they managed to put their prices up 11% and their volumes were flat. So
Oh,
these companies that are high quality companies with pricing power are still managing to push
managing.
through price increases.
okay, brilliant. Oh, well, I'm conscious of time, so we have got quite a few questions. Do we go for one more?
Yeah, I think go for one more.
Well,
Yeah.
is there anyone else in the audience that wants to ask a question, or should I go from the ones that have been submitted in Slido? Yeah, you'd like it, yeah. Do you have a particular question? Have you submitted one? Yeah, what's your name? Roman. Okay, I will have a look for your question, Roman. Unless you've submitted it anonymously. Would you like to stand up and ask it? Could we get a mic to Roman, please? Thank you.
Thank you. Dear all, thank you. My name is Roman. So I have a couple of questions that I like. So what are your thoughts on companies that in agriculture sector in Ukraine that dropped for 50-60% on their valuation? Thank you.
I think I can only answer from my experience in investing in companies that link to that. And the one example I can think of is a company called Bayer Corporation, which has the leading crop science sort of business in the world. And their share price went up tremendously at the start of last year when the Ukraine war, sort of came through to fruition because of the spiking grain prices. So, and they're also doing tremendously well this year. So I think that is my experience there with those companies. We still think there's actually very good upside in the name because it also has a pharmaceutical side of its company, which are essentially getting into free, and it's got a litigation overhang. But there are companies that are benefiting tremendously from the increases in these sort of soft commodities as a result of the Ukraine crisis.
Do you have an opinion?
Yeah, I mean, I guess, I wouldn't know anything about any particular company. I would just say, I guess, the war is obviously a major energy and food price shock and a fertilizer shock as well because of the sanctions. I have the impression that, because of the grain deal to allow Ukrainian exports most of the time to come through, that, it's the world economy is readjusting to that, but there's still some issues, right? Because the grain deals appear to be coming into question from time to time. It's not really clear how the war itself will, eventually come to an end. You could imagine that there'd be a stalemate of some kind, right? Or that there would be a conflict that goes on for a long time, that it won't come to a very quick and clear end, right? There are lots of conflicts like that remain unresolved for long periods of time. And I think there are good reasons to expect that to be the case with this one, which would suggest that that commodity prices, especially energy and soft commodities, remain relatively high priced for some time to come. And that, we have to keep, doing what we can to make sure that there's enough grain being sold for Africa and other parts of the world that are, that don't produce enough grain to feed themselves. And I think it's worth thinking back to the Soviet era. In the Soviet era, the Soviet Union was a big importer of grain from the US, right? So you know, the Americas stand to benefit from this, right? In some respects.
Excellent. Thank you so much. Well, ladies and gentlemen, apologies we've overrun, but I hope you've enjoyed the discussion. Please join me in thanking our experts, Fiona Mullen from Sapientia Economics, Arnab Das from Invesco, Hannah Gooch-Peters from Sanlam, and finally, Gregory Kumar from Starsis. And I'd like to thank all of my colleagues who have helped to organize this event. Hopefully, you know, you will go on and enjoy the drinks and food that we've got on for you after this. Thank you to everyone who's joined us online as well. We hope you stayed with us. And if there are any questions we haven't answered, we will do our best to submit those to the panel and send those out, post those out with the highlights of this. Yeah, if you like to join us for some drinks and some food, please do. But thank you once again to everyone, and we hope you've enjoyed this second event.